A long-term disability can take you out of the workforce with little or no warning, leaving you without a paycheck. Watch this video until the end because one detail could make a huge difference in your benefits. With no income, bills can pile up quickly. Social Security Disability Insurance, SSDI, can help you stay afloat. It offers monthly benefits to help you remain financially stable when a serious medical condition keeps you from working for at least a year, if you meet Social Security's medical and work requirements. What is Social Security Disability Insurance? SSDI is a federal program that replaces some of your income if a long-term disability prevents you from working. The program is funded by the Social Security taxes workers pay throughout their careers, so your eligibility and benefit amount are based on your earnings and work history. Who qualifies for SSDI benefits? To qualify for SSDI, you must meet two sets of requirements. You need enough work history under Social Security, and your medical condition must be severe enough to keep you from working for at least a year. SSDI provides benefits to workers who are paid into the Social Security system, so eligibility depends on both your earnings record and the nature of your disability. Work requirements for Social Security disability eligibility. You earn SSDI coverage by working and paying Social Security payroll taxes. Each year, you can receive up to 4 work credits based on your wages or self-employment income. For 2026, 1 credit is awarded for each $1,890 you earn. Social Security uses 2 tests to determine whether you have sufficient recent work history to qualify for benefits. Fully insured. Most adults need about 10 years of work, equal to 40 work credits, to be considered fully insured. Some of those credits must have been earned recently. Currently insured. In most cases, you must have at least 20 credits from the 10 years leading up to the year you became disabled. This rule ensures that SSDI benefits are primarily paid to workers who were recently in the labor force. Special rules for younger workers. Workers who become disabled early in their careers may qualify for benefits with fewer credits. If you were disabled before age 24, you may qualify with as few as 6 credits if they were earned in the 3 years before disability. Workers disabled starting at age 24, but before turning 31 generally need work credits for half the time between age 21 and the date of the disability. For example, someone disabled at age 27 would typically need 12 credits, 3 years of work. To qualify, medical requirements for Social Security disability eligibility. In addition to work history, you must show that you have severe, long-term medical impairment that will last at least 12 months or result in death. The Social Security Administration evaluates whether your condition prevents you from doing work that earns more than a set monthly amount, known as the Substantial Gainful Activity, SGA, limit. This standard applies to any type of job, not just the kind of work you've done before. How SSDI benefits work. Once you're approved for SSDI, you receive a monthly benefit based on your earnings history. Social Security calculates this amount using your averaged index monthly earnings, AGME, which reflects your lifetime earnings after adjusting for changes in the national wage level. In general, higher earners receive higher SSDI benefits than lower earners. Social Security then applies a formula to your AIME using 2 thresholds called bend points. At each bend point, the percentage of your earnings that's replaced changes. Lower earnings are replaced at a higher rate, and higher earnings at a lower rate. For 2026, the bend points are $1,286 and $7,749. When SSDI benefits begin, a 5-month waiting period applies from the onset of your disability. You become eligible for SSDI in the 6th full month, but payments don't begin until your claim is approved. How SSDI benefits interact with other Social Security programs. If you become disabled before reaching full retirement age, SSDI can pay a higher benefit than taking Social Security early. But if you've already claimed early retirement benefits, those reduced payments usually stay in place even if you later qualify for SSDI. For workers who are eligible for SSDI, applying for disability before claiming early retirement can result in a larger monthly benefit. Factors that can reduce or affect SSDI benefits. Several rules can change the amount you receive or affect whether your SSDI benefits continue. Earnings and work activity. You can test your ability to work during a trial work period, when benefits continue regardless of how much you earn. After those 9 trial months, Social Security looks at whether your earnings exceed the SGA limit. For 2026, the SGA limit is $1,690 a month for most workers and $2,830 for workers who qualify under Social Security's blindness rules. After the trial work period ends, the extended period of eligibility allows you to receive benefits for any month in which your earnings fall below the SGA limit, workers' compensation, and other public disability benefits. These payments can reduce your SSDI benefit because of offset rules. Substance use. Benefits can be denied or ended if substance use is found to play a significant role in the disability determination. Taxes on SSDI. SSDI benefits themselves aren't reduced, but you may owe federal income tax on SSDI payments if your household income exceeds certain thresholds. How to apply for SSDI benefits. You can apply for SSDI benefits online, by phone, or in person at a Social Security office. To complete your application, you'll need documentation that helps Social Security evaluate your medical condition and work history. Be prepared with detailed medical records, information about how your disability affects your daily activities, a list of your doctor's treatments and medications, your work history and earnings information. SSDI claims often take months to process, so having complete documentation and starting the application as early as possible can help. Some applicants also work with a claims specialist or advocate who can assist with gathering paperwork and navigating the process. SSDI versus SSI versus private disability insurance. Supplemental Security Income SSI is a separate federal program that provides monthly payments to people with limited income and resources who are age, blind, or disabled. It is a need-based program funded through general tax revenues and available only to those who meet strict financial eligibility rules. SSDI, in contrast, is funded through payroll taxes and available only to workers with enough work history. SSDI and SSI both differ from private long-term disability insurance, which operates outside the Social Security system. Policies vary, but private disability insurance often uses more flexible definitions of disability and may replace a higher share of your income. Some long-term disability policies also pay benefits if you can't work in your current occupation, a feature known as own occupation coverage, even if you could work in another one. Here's how SSDI, SSI, and private disability insurance compare at a glance. The bottom line: SSDI can provide steady income when a serious disability prevents you from working, but qualify depends on your work history and meeting Social Security's medical rules. Understanding how the program determines eligibility, calculates benefits, and coordinates with other income sources can help you know what to expect if you should need to rely on SSDI. Subscribe now to stay informed and financially protected when disability changes everything.